Okay.
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Nick Tell, CEO of Armory Group, to discuss the cause of the next distressed market cycle. Nick, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. I really appreciate having me on.
Thank you so much. And the U.S. government's massive fiscal spending will end while ongoing supply disruptions from COVID will cause inflation to continue upwards at a faster clip. What will this cause, and why will investors be caught off guard?
Well, I think the Fed's meeting minutes are a prime example. Is that the belief right now is that these inflationary concerns are transitory, and the Fed continues to say that, but it's starting to manage expectations because of concerns that these supply side shocks are actually going to go longer than what they expected. Really what happens is, and this is what is a classic definition of stagflation that we're starting to see right now, which is you have increasing pricing, even though you have moderate demand, economic demand, and you have relatively high unemployment. Now, how does that happen? What happens is that it's actually the supply side that's driving the inflationary pressures. And you're seeing that today with COVID supply side disruptions. And that really can't be controlled by the Fed. What can be controlled by the Fed is consumer demand. And as you mentioned, there's a lot of stimulus that really has pushed consumer demand over the last, call it 12 to 18 months. That's starting to hopefully work its way out of the system, ultimately causing a moderation in demand. And you're seeing COVID actually now being cited as a reason that you have some moderation in demand. So oddly enough, what you have right now is the CPI is starting to moderate, but really the bigger issue that I think has not been focused on is the producer price index. What you have right now is you had over the last 12 months, the producer price index, or the PPI, has gone up 8.3%, where the CPI has gone up 5.3%. So that's a negative spread that started in January that typically will squeeze margins, and that impacts both the margins for public companies as well as private companies, impacts equities, impacts debt. And as a result, what ultimately, if it doesn't moderate, ultimately translates into more defaults, more issues, and bottom line, increased costs of credit.
Right, and that's really what the issue is when you talk about cost of credit. How will this impact asset prices and, more importantly, bond yields? Because we know the Fed is just so dependent on a couple of those data points.
Yeah, and I think you think about in terms of fixed income, you got to think in terms of both credit quality and duration. And both will have different impacts depending on where you are on the credit spectrum versus duration. Longer term, longer duration will be negatively impacted because and create a lot of volatility because effectively you've got record low interest rates right now with the expectation that the growth will continue and that effectively assets are fairly priced, where I believe that in fact they're not. That right now you have a lot of frothiness. And so duration itself is going to have an impact in volatility in the fixed income market, but also credit quality. The lower down the spectrum, the credit quality, the more at risk you have with margin compression.
And Nick, small and mid-sized businesses are so important to the American economy, but don't they also stand to lose the most?
Well, I think they're the most vulnerable. And I view them almost like the canary in the coal mine, if you think about it, because ultimately they're the ones that are going to be hit first with margin compression. On top of that, they're getting hit already because they have floating rate. I'd say 80% of their capital structures are in floating rate debt. And that's based on LIBOR, which is the most sensitive interest rate indexed out there that moves first relative to treasuries and all these others. And then on top of it, as you have raw material pricing spike and almost double in many cases, especially in the manufacturing sector, that's a liquidity impact because now they have the working capital has now doubled in terms of size for a lot of these smaller companies. They don't have the facilities, they don't have the liquidity to withstand that. So you're starting to already see this squeeze starting to happen in the lower middle market, particularly in the manufacturing sector, even though demand is staying relatively strong.
And Nick, to wrap up here, how should investors position themselves in advance?
Shorten duration and hedge against credit risk. I'm telling my clients to sell out of high yield because you're just not getting paid right now because you've got the high yield market trading around 4%, which is the first time it's trading below the CPI ever. And so you're just not really getting paid right now for the risks that are associated. And so sell high yield and leverage loans, be higher quality, and then focus on private credit because there's some opportunities in private credit because that market is not as frothy and it's floating rate typically. And so it gives you an opportunity for the right manager to actually withstand sort of the credit cycle that we're about to take on.
All right, Nick, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Joe.